All right, guys, you're back with Steph and Dennis. Obviously, it's just me here today. And honestly, I'm like really excited about today's video. We kind of teased it a couple weeks back when we were talking about how I like changed up my entire investment strategy and portfolio. And yeah, basically today we're gonna be taking a deep dive into the world of one fund solutions. So I think there's a lot of, fan favorites across YouTube when it comes to different ETFs that you can buy, when it comes to different mutual funds that you can buy. And ideally you're not buying mutual funds, but we all know about the VTIs, the VOOs, the VTSAXs of the world. But I feel like a lot of people don't really give enough context as to why they're buying that particular fund. And, I know that there's a lot of people on the sidelines who haven't really taken the leap and don't feel as confident as they should be in making their initial investments or even transitioning a more complicated portfolio to something that actually makes more sense and is more conducive to your lifestyle. So yeah, we're gonna be taking a deep dive into that. I'm gonna head over to the laptop right after this, or the iMac, I should say. And yeah, I'm gonna walk you through basically my thought process. We're gonna do a little bit of comparisons and then yeah, let's get it. All right, so what's a one fund solution? I feel like this is a term that we've been talking about a lot lately, but we haven't actually defined what it is. I would picture it, and this is exactly what it is, as one ETF that you can buy that holds a bunch of other globally diversified ETFs. So another much more easier example to give you would be if, let's say, you're gonna buy a gift basket for someone. You can either go to a bunch of individual stores, pick out a whole bunch of different products, and put it together when you get home, or you can go to one of those stores that sells pre-made gift baskets that more or less have everything inside of them, but you just buy it one time. Now, what I want to say is that the reason that this investment product is so good, the one fund solution that is because it keeps things simple, right? At the end of the day, if you're a long-term investor, you want things to be as simple as possible and you want them to be as automated as possible. So that's something we're going to talk about. So before we even get into XEQT and VEQT, one thing that I did want to mention is around the X and the V in VEQT and XEQT. So this is kind of how you distinguish the different institution that's made the investment product. So X we know is iShares from BlackRock. V we know is Vanguard, right? At least I hope so. But yeah, basically before we even dive into that, I do want to also mention that there's other products as well. Like XEQT and VEQT is going to be the focus of this particular video, but there is XBAL and XGROW, there's VGROW, there's VBAL, and the main difference between these different one fund solution products is the level of volatility, right? So the exposure that you have between stocks and bonds. So VEQT, we've mentioned before, is 100% equity, so 100% stocks. Whereas, for example, XBAL is going to be 60-40, so 60% stocks, 40% bonds. XGROW, on the other hand, is 80-20. So you can kind of gauge that yourself, right? Like, you know what your time horizon is for how long you're going to be invested in the market. You also know how comfortable you're going to be with risk, right? Like, we've gotten a recent question because of what's been happening in the market lately around whether I'm planning to buy, an additional one fund solution fund to give me more exposure to bonds. And the answer is no, right? This is, when I see XEQT going down because of what's happening in the market, that's a good thing, right? Like, I'm just as happy as when it goes up, because that means my dollar cost averaging is doing what it's supposed to be doing, right? You're supposed to be buying when those times are low, middle, and high, right? Like, that's just, and then at the end of the day, it averages out to hopefully, a good price, right? So if we look over here, we can see that XEQT right off the bat, when we're looking at the Google Finance portion of it, right, has performed rather well, right? They've done well. They were founded in 2019, same with VEQT, but we'll get into that in a second. But like I was saying before, if we look at their holdings, basically you're buying one product that holds a bunch of other individual products. Like, I could go out and I could buy this one ETF here that tracks the US stock market and just invest in that if I wanted to. But then I wouldn't have a globally diversified portfolio, right? So that's why most people, right, when they have a self-directed account, they'll buy a bunch of ETFs. They'll go out and they'll buy a US one, maybe a Canadian one, an international markets one, and an emerging markets one. And if we go here to the graph and we look at the graph, if we go here to the map and we look at the actual breakdown, you can see that the US is the largest one, Canada, Japan, United Kingdom, and so on and so forth, right? A question that you might be asking is, we've mentioned this before, if Canada itself only accounts for about 3% of global market cap, why do they have their weighting at 25%, almost 25%? Well, a big part of that is actually something called home bias, which we've also talked about. So basically what home bias is that usually depending on where you are, like this happens a lot in the US too. This is why you hear so many people on YouTube specifically only talking about buying VTI and VOO because of home bias. A lot of us as investors, a lot of us a lot of the institutions as well, when they're making products for their own people, there's that home bias component where they attribute a lot more to their at-home economy. Now, I don't really mind, right? The reason I don't mind is because the Canadian economy hasn't performed like terribly. If we look at historical returns, it hasn't done great. But at the same time, I am invested at 44, almost 45% in the US by buying this product, which honestly, I'm happy with, right? And you're gonna notice that once we go over to VEQT as well. VEQT is a very similar product. One of the major differences that you're gonna see is that they actually invest just a little bit less in the US and a little bit more into Canada. But that's kind of been Vanguard's style with any of their Canadian products. So yeah, I don't know. Similar products, we're gonna get into the fees and all that in a second here, but more or less, like I said before, if you look at the funds that it holds, it has a fund that tracks the total US stock market, total Canadian, developed, so excluding North America, and emerging markets, right? You'll notice that it's a little bit less in the US, a little bit more in Canada, like I said. It's very similar products. Now, if we jump into an actual comparison, you're gonna notice right off the bat here that there's a management fee and there's an MER fee. A lot of people often wonder, which one am I supposed to look at? Well, both percentages are really good to know. The management fee is really good to know because ideally you want that to be as low as possible, and you also want that transparency around how much they're actually charging to manage the product, right? But the MER fee, that's the one that you should be looking at and is often higher, right, than the management fee because it's all encompassing. It's all the costs associated with maintaining this product. So you'll notice right off the bat that VEQT, which is here, has an MER of 0.24%. It used to actually be 0.25, but they've actually gone down. And then you'll notice XEQT is 0.2%. So the difference in both these products, if you have, let's say, a $10,000 portfolio, is a difference of paying $4 a year. So with VEQT, you're paying about $24 a year just to be able to invest in this product. And with XEQT, you're paying about $20 a year. Really not that big of a deal, not that big of a difference. They are, like I said, they are very similar products. And this really shouldn't be the deal breaker in terms of which product you choose over the other. I think for me, what I was looking at, obviously did look at the fees, but what was more important was actually getting a lot more, a little bit more US in there and not going with the product that had more favor to Canada. Right? If we look at Canada's performance, I don't know, over the last decade, over the last 2 decades, it has, drastically lagged the US. But if we go down here for a second, you'll notice that the yields are different. Now, I will point out that the distributions of the yields are also different in the sense that VEQT with Vanguard distributes annually, whereas XEQT just distributes quarterly. But yeah, more or less, once again, similar products. I already mentioned that they're both formed in 2019. If we look at the portfolio turnover rate, right? If we look at that for a second, their holdings, once again, in terms of the average market cap, should be rather similar. If we look at the portfolio turnover rate, this is a really good metric to look at because it looks at how often there's changes by the actual portfolio managers that manage these funds. There are portfolio managers that manage these funds, make changes within the portfolio. So a higher portfolio turnover rate likely indicates that the cost would potentially be higher for that specific ETF. Now, if we scroll down a little bit more and we look at the sector breakdown, so this one's really important to take a look at because this might be where you find your differentiator between the different funds, right? So let's say you're someone who believes that, for example, technology is going to do well in the future over financial services. So that might mean you want to choose one that has more favor towards the technology sector, whereas another one has more favor towards maybe healthcare or real estate and industrials. If we go down to the market allocation, right, this is where you're gonna see the full breakdown of all the different countries. Another thing that I did want to mention, and it's a question that we got, was around whether I sold off my factor investing portfolio? The answer is yes. If I'm no longer invested in the strategy in the short term, maybe I am in the long term, if I'm not gonna be keeping up with it, and if I'm not gonna be maintaining that portfolio, it doesn't really make sense for me to keep it and let the allocations get out of whack. And then all of a sudden I'm paying money, but I'm not seeing the actual returns, right? At the end of the day, if you have a strategy, you need to be following it for the long term. That kind of wraps it up. And I think if you take that approach when you're looking at the different funds as well, and our messaging, especially for young people, really is take a look at your risk appetite, right? But at the end of the day, understand that if you have 20, 30, 40 years to be invested, you can afford to take on that risk, right? And we're not telling you to go out and buy a bunch of different single stocks, right? This is investing in something consistently that is well diversified. So anyways, that's just something to consider. That kind of like wraps things up. If you guys have any other questions, any other thoughts, let us know down in the comment box below. And yeah, you know the vibes, let's go.